Awesome. We're going to get started. So my name is Saad Dar. I lead business development at Baselane. Today we have Renesha Davis, a very experienced CPA that is going to be joining us to talk about some really key topics that we all need to learn about. Just some housekeeping before we get started. This is being recorded. This will be posted on YouTube, on the Baselane YouTube channel. And for all of you listening, if you'd like to get the recording, we'll also be sharing that with you after we have the session completed. So thank you so much for joining. And before I kind of like jump over to our guest, let me just pull up some key pieces of information here to introduce her. Then we'll do a quick intro of Baselane for anybody watching the video that doesn't know what Baselane is. And then we're going to jump right into it for the next 30 to 40 minutes to talk about bonus depreciation as it relates to real estate investments. So without further ado, please welcome Renesha Davis. Thank you so much for being here. And I know that we have something to share here. So I'm going to be sharing a little bit of an intro about you. And so I just found out, I think I knew this from before, but I forgot that Renesha and I are actually probably about 30 minutes from each other today, calling in from northern part of the Atlanta, broader Atlanta area. So really exciting to have her here. Like I said, she's a very experienced CPA with over 15 years of experience. And she specializes in many things related to real estate. So we're going to be learning about that. But I did want to let Renesha say hi and introduce herself first.
Hi, everyone. Hi. So just very quickly, I love supporting small businesses, and my path into entrepreneurship really started after I became a twin mom. So I felt like I couldn't keep up in the corporate America space, and I needed something that was more flexible. So I started my entrepreneurship journey in 2018 when my kids were one at the time. Fast forward, I knew that I wanted to work in specific spaces related to real estate, legal, and wellness preneurs is what I call, and specifically focusing in the service element of making sure that you can understand the legacy math equation. So how do you really activate wealth, slash your taxes along the way so that you can preserve legacy for your family upon like multi-generationally. I am a certified public accountant, and a fun fact about me is I was a school bank teller at the age of 9.
Oh, wow. Okay. I don't know how you did that.
It was very interesting. It was in our elementary school. The whole goal was really to teach us how the importance of saving and interest rates. It was at the time, I think in fourth grade, when we were learning math, we were learning multiplication and division, right? So it was really to teach us about the compound interest. And I really took into understanding how the bank worked, and that's where I decided that, oh, I want to do something with money when I grow up. So that continued into my high school when I took my first accounting class, and the rest was history for my undergraduate and graduate degrees.
That's awesome. Thank you for sharing that. And I know today the key topic really for discussion is going to be about bonus depreciation, what it is, how does it work, who can benefit from it, how can you actually implement it in your real estate business. And there's some key questions I think you've highlighted here, like, are you active versus passive? What are sort of the impacts on cash flows, good and bad, as well as what is cost segregation? How much does the cost segregation study really cost? How do you do it? How can you do it? And when should you do it, right? All of those things are going to be covered here. And so we'll get into all of those topics. Before we do that, I did want to just do a quick overview of what is Baselane. And I think most of the audience probably here already knows about Baselane, but for those that don't know about Baselane, Baselane is a digital banking platform that is focused on helping individual and smaller investors run their real estate business. We provide 3 core services, which includes digital business checking account, which is really a digital bank that helps you organize and automate your day-to-day operations and financial workflows. We offer a bookkeeping and reporting software. In addition to that, we also offer property management tools like rent collection and tenant management and all those things. And so again, basically it helps you on one platform automate and organize yourself so that you can run your real estate business more efficiently. And our goal is to give you back time and give you more visibility and control, thereby allowing you to generate more passive income and achieve your financial objectives and goals. So without further ado, I think we're going to be just getting into it. So I guess, Renesha, maybe we can just start with the basics, right? I always like to do this because We don't know the level of experience of the audience, and we can talk about that. So the first question for me really is going to be, what is bonus depreciation and who should be thinking about it? And
Mhm.
while I do that for the folks here, we do want to launch a poll just to get to know you better. So Renisha has a little bit more insight about you as well. Um, Jake, I can't see the poll, by the way. I don't know if you can launch it on your side.
Let's see.
Oh, there it is. Okay, so getting to know you. How many rental properties do you own? What type of rentals are in your portfolio? What are the biggest challenges in real estate? So that's live. Please go ahead and fill that out while we start with the first question of the day, which is, what is bonus depreciation and who should be thinking about this?
So think of bonus depreciation being like a extra credit that you get on your tax return, right? Not everyone qualifies for it, but bonus depreciation allows you to accelerate, take depreciation faster. So if we talk about the basis of what depreciation is, then I think we can step into what bonus depreciation is. So depreciation in general allows you to write things off over time as you own them. The way that the IRS sees it is when you buy a piece of property, whether it is in real estate or let's think a computer, if you will, that computer will last for a certain period of time. Most computers, the IRS has a definition that says most computers last for 5 years. And if the computer costs $2,500, you divide that by 5, and that is the benefit towards your tax return. Now, when we add the word bonus on top of that, right? Bonus just means, do I get to take it now? And does it qualify for certain tax code rules outlined by the IRS? So bonus just means you get to take it faster. And you can take it now versus later. When Trump was in office, he pretty much said, hey, bonus depreciation is good, but it's going to begin to phase out. And we're in the year where bonus depreciation is only worth 60% of that bonus credit, right? So when I think of bonus, it's like, yay, I get this extra credit, but I only get to take 60% of what it's worth, and only certain class of assets fall into that bonus depreciation threshold.
Yeah, that's super helpful. So just to kind of level set, the typical what we call straight line depreciation, which is really just depreciating an asset like a house or a rental property equally across, the specified number of years, which I think is usually about 27 and a half years.
27.5. Yep.
Right. That means you take the value of your house, along with capital improvements as you're having them, and take the total divided by 27 and a half and take that as a depreciation on your Schedule E every year. Here you're telling us you can actually take a bonus on that and accelerate, meaning move some of that or a lot of that depreciation up front loaded.
Yep.
And you also mentioned there's some sort of a sunset. So is the 60%, is that the current amount you can take? So meaning
Yeah.
it used to be 100% and now it's 60%?
Correct. So it phases out every single year and it reduces by 20% each year. So for 2024, it's 60%. For 2023, it was 80%. For 2022, I think going back from 2018, it was 100%. So now we're in the year where it's only 60% of the value for 5-year and 15-year classes. And that's where, in order to take it for real estate, that's where the cost segregation analysis come into play, because traditionally bonus depreciation is not for homes. It's not for 27 and a half asset classes. It's usually for 5-year and 10-year asset
I
class.
see. Okay, that's helpful. And by the way, I think we just want to do a quick pause here on the polls. So I'll pull that up in a second. I have one more question on that. So I guess two questions related to that. When is it getting fully sunset? Meaning how long do we have
Mhm.
until it hits zero? And is there any conversation going on? Is there regulation coming that might refresh it or renew the whole bonus appreciation tax benefit?
Okay, so for 2025, it reduces to 40%. 2026,
Okay.
it reduces to 20%. And in 2027, it's automatically phased out. There has been some
Ah,
legislation to renew bonus depreciation. We know it's an election year, so anything can happen.
yeah.
But I know specifically the last time I read up on it, bonus depreciation was renewed for, I think, aircraft parts. Don't quote me on that. But
Okay.
there is some talks legislation wise to renew bonus depreciation. And bring it back to 100%. We just don't know if and when it will happen.
Okay, that's helpful. And just for the poll, just for your knowledge as well, in terms of, who's listening, it seems like a pretty kind of like even split. A lot of folks with one or two properties, and then about 40% have 4 to 10, and about 7-8% have 11 or more. What types of rentals are in your portfolio? The vast majority here, 94% have either midterm or long term. About 6% have short term right now. And then there's a mix of, other properties in here like commercial, etc. after that. And what are your biggest challenges in real estate was the third question. And here we see that 46% are saying I'm trying to grow my portfolio but unsure of next steps. 69% said I'm looking to finance my next investment. 62% said I'm trying to finance my next property. 15% said I'm not sure how to run my properties like a business. So just to give you an idea of some of the listeners that are here, and I'm sure this is also representative of, the broader real estate market of people that might be watching this video on YouTube or other places that we post this on. So thank you everybody for doing that. We appreciate that. That's super helpful information. So let's continue with this discussion. So we've talked about bonus depreciation. We talked about what is it. Basically, you can accelerate the depreciation of certain assets to earlier and more of it sooner. Basically, there is a sunset rule, seems like. So there is a limited time on it as of now. Fingers crossed, maybe it will, actually maybe renew or get passed again, depending on what happens with the elections. We don't know that. So that's another thing. And then you talked about cost segregation. So before we talk about like what are the property types and assets that we can think about, could you tell us a little bit about that? Like, what is cost segregation? What is a cost segregation study?
Yeah,
And
absolutely.
yeah, how does it relate to bonus depreciation? Like, why do we need that for bonus
Yeah.
depreciation?
So traditionally, when we think about real estate, 27.5 year classes do not qualify for bonus depreciation, full stop. And then when we think about commercial real estate, there's also a rule as far as like whether you own the commercial building and if bonus depreciation qualifies in that regard. So I won't complicate it and we'll focus specifically on residential, right? So in this situation, cost segregation comes into play because think about you have a full pie and you get to split that pie into three pieces. The three pieces for the pie, 100% is the whole house, but you have things in the house that have different asset classes, right? So the roof might be 27.5 years, right? But the other assets, such as the refrigerator that you have in there, the stove that you have in there, the AC unit that you have in there, those would fall somewhere between the 5 and 15 year classes. So if we think about
Mm,
the whole pie, you now get to split that pie into three pieces. When we break up the house into three of those pieces of the pies, what's in the house falls into the 5 year bucket, what in the house falls into the 15 year bucket, and what are the remaining pieces that stay in the 27.5 year class that you can't accelerate depreciation on, right? So in
okay.
that traditional sense, if I have a property that is $100,000, keeping it simple, and my 15 year classes, 70% of that property falls into that category. Well, then 70%, when bonus depreciation was at the 100%, you could write off $70,000 in that 1 year, that first year. So that's shifting the full value of the house. Instead of doing 100 times 27.5,
Right.
you now have 70,000 that you get to take, and then the remainder 30% smooths out over the 20.
Stays. That's super helpful. So that helps. That's a very visual pie diagram of like what happens with the split. So the three sections, so a 5 year, just to make sure I got it, 15 year, and the typical 27.5 year categories. Is that
Correct.
right? Okay. And this cost segregation study, that's helping us figure out how to allocate the stuff inside of that property or on the property, like a roof, the
Correct.
walls, the flooring, into one of those categories. Is that
Correct.
right?
Correct.
Okay, that's great. Awesome. And so that's helpful in terms of just understanding the fundamentals of what is the depreciation and bonus depreciation and what is cost segregation, right? Before we get into like how it actually works and how do you do it, I wanted to talk a little bit about who is this useful for? right?
Mhm.
I told you a little bit about myself. I've got like about 18 total units. Some people, as you saw in the polls here, they've got, a couple of properties. There's some have 4 to 10, some have 11 plus, mostly midterm, long-term investors here on the call, some short-term, but about 6%. And so when I ask that question, like how are we thinking about that piece? Is it for all real estate investors or only for some?
Only for some. So in the case of being a CPA, our safe answer always is it depends, right? So in answering that question, I'll answer it from two perspectives. I'll answer it from a theory, what the IRS tax code says, and
Okay.
then I'll answer it from a strategic standpoint. Okay.
Okay,
So
and I think that's great, and also maybe just maybe some people are not in that category, but we can talk about how do you get into that category
yeah,
as well. Yeah.
yeah,
Okay.
exactly. So, theory wise, the IRS has two definitions that are crucially important to determine whether you can play in the sandbox of bonus depreciation. And those definitions are you active real estate investor or are you passive? And
Mm,
the way to just oversimplify, I always tell people that you can't really take this advice and run with it. I definitely say book a business evaluation so that I can really dive into your specific situation. But
yeah.
the oversimplified version is there are certain ways to be treated as an active real estate investor. And when active income is active, you can basically lump losses together with other income. So if you own another business that you put your blood, sweat, and tears in, and that too is considered active, then you get to lump losses with that. And the reason why I say losses is because bonus depreciation usually generates a loss, right? So you get to lump losses with other active income. Okay. And the way to be active is to either be a real estate professional. Okay. So if you have your real estate license and you participate, I believe the hours is 350 in managing the property yourself, then you're considered an active trade or business from a real estate standpoint, and you can treat that property portfolio as active income. Now,
Yeah.
non-active or passive, if you will, is if your rental portfolio is passive. Think about this as you have a property management company that's managing the property. You don't have a real estate license, and you just really make the money on the side, and hopefully it brings in a profit. Well, in that situation, the IRS defines you as passive, and if you have losses in your portfolio, they end up being trapped. And what I mean by trapped is you don't benefit from those losses when they are passive and you have no other passive income to offset the income in the passive category. So think of it as two lanes. Is this income
That's
going to be
helpful.
treated as
Yeah.
active? If yes, it's going to be beneficial to me. Or is this income going to be treated as passive? If not, if yes, I need to have other passive activities where I can benefit from the real estate losses that I have.
Yeah, that's super helpful. And I like the way you described it. Basically, like maybe to say it another way, when you look at your schedule E and you have some losses, but it doesn't help you
Yeah.
against your W-2 income and you get angry.
Yeah,
um,
exactly,
think about that
exactly.
moment on your 1040 when you're doing tax return and you're about to file. Then you're like, hey, how come this loss over here doesn't do anything?
Exactly.
The answer, what you just gave, is the answer, which is because you're considered passive, you're unable to take that loss unless you have other income that's in that category, passive
Correct,
category, right? Okay, that's helpful. So on the active side, that's helpful. I've heard different things about this, so I'll tell you what I know, and I'd love to just understand is that right or wrong, and all of that stuff.
okay.
So if I'm not a real estate professional, which I'm personally not, and I don't know about the audience, but I'm assuming a lot of them are not. I know there are certain requirements where, depending on the property type and how many hours we put in, and also how we track those hours of the work that we do, we can be considered the same real estate professional status or active
Yes,
status.
yes, the hurdle is just a little higher, so you know how in track and field you see the low hurdles and the high hurdles?
Yeah.
So if you don't have your real estate license, think think of your hurdle as being bigger or taller, right?
Okay. Okay.
So, the hurdle for real estate professionals, my understanding the last time I researched it was like around 350 hours, whereas when you don't have your real estate professional license, it's actually around 750 hours, and your hours have to be more than the other people that manage the property, right? So, your
Oh, wow.
property
Okay.
management company, and that's what usually knocks a lot of people out. So, if you have a property management company, full stop, it's like, well, what else are you
What are
managing?
you doing?
Right.
Right.
Right,
Right.
and it
Right. Right.
also
Okay.
includes, like, the groundskeeper and the house cleaners and all of that, so the level
Mm.
of documentation, that's why I say the hurdle is taller, because the level of documentation required, is similar on both sides, whether you're a realtor or you are considered a mom and pop rental
Okay.
shop, right? So what you're talking about is really the mom and poppers who do this as a passive stream of income, who may not be full time managing the property.
Got it. Gotcha. That's helpful. So basically that, I mean, that's a lot. That comes out to about 2 hours a day, roughly. I'm just doing some rough math. So I guess the next logical question I have is for the one for us, how do we qualify for the bonus depreciation? Like what are some strategies and how do you work with people to help us think about like that process?
Mhm.
Before I get into like, hey, how should you do this and how do you do cost segregation studies and all this stuff, just understanding like how do we even get into this category to say, okay, we can take advantage of this.
Yeah, I think that's a really good question. And it boils down to specificity around your tax return.
Okay.
So the first thing I will say is that there's an election to treat the real estate portfolio as an active trade or business. There's certain things that have to qualify. The second thing that I will say are phase out limits. So if you have a W-2, um, there
Yeah.
is up to a 25,000 hurdle that you can take. So the bonus depreciation, you can apply it whether you are on the real estate professional license category or the mom and pop. It's just a matter of whether you benefit from it, right? So you can
Mm.
apply it. It's just a matter of is it smart to do it just based
And
on your status.
does that mean like if you have certain level of W-2 income, which I think I don't know if the threshold is 150 or more,
150.
150K, does that mean like if you're above that, that might not actually help you, basically?
Correct. So as soon as your
Okay.
taxable, I don't quote me on this, but I think as
Yeah.
soon as your taxable income is above $150,000, I'd have to go and really check the rules because sometimes
Ah, okay.
Maggie
Okay.
modified adjusted gross income, taxable income, gross income. I think the rule here is taxable income, right? So
Ah, okay, okay.
if your taxable income is above $150,000, then you are automatically phased out from benefiting from any losses.
Gotcha. Okay. So it sounds to me like just to make sure like you understand how to qualify and the strategy of qualifying, that is not a one fit all answer generally. We're gonna
Correct.
have to like sit down with you and just understand our situation and go through it to
Correct.
figure out if we can hit the requirements, meet the
Correct.
requirements.
And what I will say, I don't know if Ashan is on, but he can come on and give his 2 cents where, he was a corporate employee at one point and now he's not, and he's a full-time entrepreneur managing properties. And he can give his 2 cents. For him, I know that it was hugely beneficial and he ultimately does a cost segregation for all properties. And then you can decide closer towards the end of the year whether you're going to use that cost segregation or not. So
Oh, interesting. Okay.
yeah.
I don't see him in the the list here of people that have joined.
Okay.
Ashan, are you on the call with us? Are you on the webinar? Maybe you can post it as a question. I think comments are turned off,
Let me
but
show chat previews. They're on. I see one open question.
yeah, there's one question from David, which I think we'll go back to that, I guess now because we want to go back to
Yeah.
cost segregation and how do you do it and what do you learn from it. So I guess maybe let's go back to that while we're seeing. I don't know if Ashan's here, but David's question was, how do we know what components fall into each bucket? Meaning, when you want to split those into those three categories you mentioned earlier, which is the 5 year, 15 year, and 27 and a half year depreciation categories, how do we know which part of the house or the home or the appliance or whatever, the floor, et cetera, goes into which bucket?
Yeah, so you won't know. That's where the cost segregation comes into play, right? The biggest misconception is cost segregation studies are very expensive. And they're not. So there is a specific company that Ashawn used, and I'll get those details from him and email them to you accordingly. But there are cost segregation companies out there that charge $900 per cost segregation, and that $900 is a
Okay.
write, right? So while you may not use the cost segregation study in general, the cost to invest in that study is what will tell you where the assets within that property fall, whether it's the 5, 15 year, or 27 and a half.
Okay, that's awesome. So hopefully that answers David's question. To basically, you have to do the study officially. I guess let me just ask this question in case people are wondering: can you do this yourself, or will the IRS not accept that
The IRS will
as
not
a?
accept that.
Okay, got it. So you have to hire like a professional,
Yeah.
independent, third
Yeah, the
party appraiser.
calculations,
That
think about it. So I'm a finance chick, right? So, and I used to be an auditor, internal auditor, and internal advisor for a Fortune 500 company. And whenever we would go in as auditors, the question that will always come up is there bias considered in this calculation in the model that you're using? Usually, if you do
right,
something
right.
that is beneficial for your tax return, there will be bias in it. And then the second thing is this model reliable as far as like how it was built? Are there errors in the calculations and room for misrepresentation on the tax return? So that's why there are specific companies that do it. And you want to go with the reputable ones that don't cost an arm or a leg to do.
Yeah, yeah, that makes sense. No, that's helpful. So, okay, so we understand again. So we'll share some information around what types of we'll share some one or two recommendation of cost segregation as a follow up, so people can just try it out and see how it goes for them. So the cost segregation study will give us a breakdown and let us know what components or how much of the value is eligible for bonus depreciation, correct? And basically, then we go what's next from there? Now we know that,
Mhm.
okay, we have these two buckets, a 5 year, 15 year, and that's a 60%, bonus related depreciation we can talk about. What should we do from there?
You take that information and you hand it to your tax person, right? So this is where you make sure that the tax person you're working with is qualified to handle real estate tax situations, right? I always have a love-hate relationship on the tax people that go in and started doing taxes yesterday. So you want to be crystal clear on who you're choosing. At the Money Council, we do have real estate pros in our Rolodex of clients.
Okay.
But the thing is you hand that cost segregation analysis over to your tax person, your CPA, your EA, a tax professional, right?
Yep.
And they'll
Yep.
take it from there. Now, if you DIY your taxes, it's going to go on Form 4562 from a depreciation standpoint, and that's how you get the credit.
Got it. Okay. Understood. So that's very clear. Yeah, that makes sense to me. There's another question here. So let's take this question from Ian. Once I take yearly depreciation on my property, do I need to recapture it when I sell the property?
Yes.
Okay, that's pretty that's pretty simple. Yeah, so I guess that's a very specific question, but yeah, thanks for answering that. There's another component to that, right? Like if you're just a long-term investor versus short-term, some people, I mean, I think that are more long-term don't think that they can take advantage of these things. So does that matter, or is it more the active passive qualification that really needs to be cleared
I think it's
in terms
both.
of the
I think
as a
it's both.
combination? Okay.
Yeah, so I answered the a lot like the theoretical question as far as active versus passive, but we can spend time more on the strategic side now, right?
Yes.
Tax plan
Yes.
side, right?
Yes.
If you fall into active or passive, regardless whether this is a short-term investment or a long-term investment, right? Bonus depreciation is fair game. Now, how will it hurt you in the event in the future you sell for big gains? I think
Right.
that
Right.
that was the the basis of his question or her question.
Yeah, I think that's fair. Yeah.
Right? So, tax planning wise, you have to sit down and sort of forecast out where you expect to be at a point in time when you sell the property. The reason I say that is because short
Mhm.
term, we know that depreciation recapture, if you own it for less than a year, you get hit with whatever your tax rate is for that year. So, if whatever reason, if you're in a partnership and you want out of the partnership and somebody buys you out and the property is sold at a gain, within that year, short term, right? You're going to get hit
Mhm.
with your current tax rate. Now,
Right.
I always say, and I don't hate it, but like a lot of people in the real estate industry say, I want to live like Trump, right? I don't want to pay any tax, right? But I bet you, if you look at his tax return, it's because he played around. Well, I don't want to use the word play, but he strategically used bonus depreciation efficiently for his strategy so that regardless of when he sold, the taxable income on his tax return was very, very low. And as a result of that, regardless of whether you're hit with the capital gains rate or your traditional tax rate, when you compare the two and you have close to zero of a tax rate, it's still beneficial. So this is why you have to sit down and determine at what point do you expect to sell the property so that you can get your marginal tax rate down to the lowest amount so that it doesn't penalize you as much and you wouldn't experience the impact.
Got it. That's helpful. And I think with short-term rentals, there's sort of this loophole, right? Which is around if the property is a short-term rental, and I think the average stays less than 7 days or 7 days or less,
Yes.
then the 750-hour requirement doesn't apply.
Yeah.
Is it? I know you said the 750 for the non-professional.
Yeah.
I don't actually know what the hourly requirement is there in
Yeah.
terms of what you need to be doing. But
Yeah.
do you have experience with that side of things as well?
I don't, but I'm sure there's probably a Rev proclamation code that we could reference. A lot of tax, I always tell people that a lot of practitioners, right, don't know all the answers, but we have access to resources to be able to reference the tax code and the tax law associated with it. So I'm sure
Right,
there's Rev proc cases or case law that supports what the actual number should be. Um,
right.
if it ever, came up in court, but I'm not familiar with a quantifiable, like tangible number in that situation.
Yeah, yeah. I've heard some numbers, but I don't really have the specifics either right now, but I think something to follow up on maybe with
Yeah.
everybody. That's another kind of thing to look at. Again, I know most of the folks here are not doing short-term rentals, so we didn't really talk too much about that or focus on that for this topic, but if you are considering getting into it, something to think about. There's another question here from Lance. Could you talk about the interaction of 179 expense and bonus depreciation?
Yeah, so section 179 from my experience doesn't apply here. Section 179 from my experience applies to, and I'll double check this, but it applies to the typical asset classes for 5-year asset classes,
Ah, okay.
equipment or equipment uh I don't even
Like
want to use like
vehicles, like
vehicles. It doesn't,
cars, things like
yeah,
this. Yeah.
exactly. It doesn't apply to real estate.
Yeah, I think that one is a little bit trickier as well, right? Because again, if I'm not mistaken, this is also related to vehicles where depending on the weight and size of the vehicle, you can expense it with the right like criterion, meaning the usage of it is
Greater
applicable and
than
so on.
50%. Correct.
Yeah, exactly. But then again, whatever deductions you're getting there, like you were saying earlier, have to be applicable to something.
Correct.
Right? So there's the other side of it, which is like, are you a W-2 with higher income or not, and all this
Yeah.
other stuff. So
Yeah.
it sounds, I think from what I understand, it sounds like we need to do more planning with your CPA
Correct.
around the whole thing
Around the
to
bonus
set.
depreciation. Exactly. So, you know, I always say, so I had a mom and pop real estate company who have a duplex in their portfolio, but they are high income earners. So in this situation, it didn't make sense
Ah,
to do a cost segregation analysis because they wouldn't have been able to leverage that because their income, their taxable income was above 150,000, right?
right,
In this situation, I had suggested that they do use the short-term rental strategy because in that point, you can group rental properties together and you can traditionally say that it's a trade or business and you would be able to experience those losses, but there's specificity around the rules for the IRS. So I always say it's just best to have that conversation with the CPA so that they can prepare a tax research memo for you. And
yeah,
basically the tax research memo goes into the details of what the question is, pros and cons associated with case law that we saw support the decision that we were going to make as your CPA, or things that went against it. And then I don't want to use the word rule, but we opine on what we think is the best
right.
case for you based on certain facts related to your tax return.
That's a really important. That's why you need CPAs like Renisha and folks that she works with because they got the experience and they know the tax code. Um, there was something else I think a little bit about like how can we use our tax savings to finance our next investment. I know
Yeah.
we had it on the agenda. Do you want to touch on that a little bit?
Yeah. So think about depreciation when you book that loss. This is like, we used to have like a little play fund in corporate from a budgeting standpoint where we would have all these strategies on the board and we'd be like, we're gonna execute strategies 1, 2, and 3. But if we exceed our goal, that's like extra, like a bonus for us, and we get to celebrate, right? So same thing for bonus depreciation. When you book a loss on your tax return, depreciation is currency on your tax return, but you don't have to swipe your card for it, right? So in the example that I gave earlier, where a property is $100,000, and back in 2018 when bonus depreciation was 100%, you got a $70,000 write off, right? For the 70,000 that fit in that 5 year and the 15-year class, you got a $70,000 write off that you didn't have to swipe cash for. So what does that mean,
Right,
right? And let's say, $70,000 and your tax rate was 20%. Well, now you just got a $14,000 tax credit. I'm using it very loosely. You
right,
got $14,000 that you benefited from on your tax return. And that $14,000 that you didn't have to pay Uncle Sam stays in the business. And now you can either reinvest it back into the business or your next property. And that's how the cash flow impact works, right? So
yeah.
that's why I say you can use it as a positive cash flow return to fund that next property or any other strategic capital investment that you want to do for the business.
Yeah, that's awesome. So just to make sure I understood it, if you are getting this bonus appreciation, it thereby reduces your taxable income, which reduces your liability in terms of what you owe for taxes, and that means you have more cash in your bank account and not with the IRS.
Correct.
Therefore, if you have that and you have that as a strategy, it helps you accelerate the savings for the next deal and the next deal. That's awesome. That's super awesome. And I think we all need to do more planning related to this
Yeah,
so we can get to our next deals faster, really.
exactly.
Um, I will see if anybody has any more questions. We'll give it like 1 or 2 minutes just to get a couple of more questions in here. And then, from there, I think we can wrap it up since this is a 45-minute webinar today. So, yeah, let us know if you have any questions. And while they're doing that, Renisha, what's the best way folks can get in touch with you?
Yeah. So if you want to go back to the other slide that you popped open for the
Yes.
agenda, there's a QR code on that slide, and that QR code should go to our email list. So we are not accepting clients right now, but we do want to stay in touch with you. And the best way for us to stay in touch with you is to be on our email list. The email list is Wealth Must Seeds. So we help you plant seeds of wealth so that you can harvest legacy. And we send out an email once a week with some goodies attached from a blog post that will help benefit your business. And we talk about things like owning a business, automations, funny stories that I dealt with as a business owner, like firing my first um, AI employee, right? But we always link it back to business so that you can experience one joy and benefit of growing your wealth.
Awesome. That's super helpful. So I think I'm sharing my screen here, and you can see is this a QR code on the top right hand
Yep,
side?
that is the
So
QR
we'll
code.
we'll we'll leave it there just so everybody has a chance to be able to scan it. So if you're watching this online, you can just take your phone and scan it on the screen on your
And then if the
desktop.
QR code is not working, it's www.themoneycouncil.com/tax guide.
Awesome. We'll send that out also as a follow up to everybody, and we'll post it in the description of the video. Uh, Christine is asking, can you refer me to a CPA? Yes, we can. We have one right here, and we'll send you the information afterwards so you can get in touch. And Renisha, are you serving all states or some states, or is there any sort of restrictions around that?
No, the beauty about a CPA is that we can serve all 50 states without restriction.
Wonderful. Awesome. And David, so we'll just ask one more question here. Did I hear you say if you make over 150K, you cannot use cost seg?
You
Is
can use
that
cost segregation for whatever. I suggest to get a cost segregation on each property because there's ways that you can group your properties together so that some losses offset income in those properties, right? So get a cost segregation always. The 150,000 applies when your taxable income is above 150,000 and you're not able to benefit from the losses that get trapped on your tax return.
right? And isn't it also true that with the cost seg study, even my regular depreciation that I'm doing, not the bonus depreciation, right? So if I'm, for example, if you were doing 100% straight line on a house that's worth $100,000, um, and you find out through the cost seg that there's a bunch of things in there that you can do 5 year depreciation on and 15 year. Can you not change the treatment of those things
Yeah, yeah, yeah.
to
So
the
how it
faster?
works, yeah,
Yeah,
so how it works is when it's 15, 5 year and 15, the bonus depreciation is attached to those asset classes. Okay.
right, right.
So if
But if
it's
you what my question is, if you don't qualify for that bonus appreciation, let's say, but you have the data now, you did the cost X study, you know
yeah,
that the fridge is only a 5 year
yeah,
asset, and the furnace is a 10 year. I don't know whatever. I'm just giving
yeah.
examples. Could you not then ask your accountant or your CPA to change the depreciation breakdown of each
Yeah,
year?
yeah, yeah, exactly. So, like, say for instance, you decided I don't want to take depreciation because it's too much for that year for me, and I don't qualify for it. But for that $70,000, you can say if 20,000 was 5 years, split it over 5 year versus the 27 and a half. Yep, that's how
Yeah.
it works
So
without bonus depreciation.
right. So meaning like even if you didn't qualify for bonus depreciation, this is still beneficial to you to do it
Yes,
because it can help you get that breakdown, and then you can depreciate those other things faster anyway because their
correct.
lifespan is shorter inherently, like an
Yep,
appliance, which I'm thinking about as an obvious one, or like a water heater,
yep,
maybe some flooring, right? Like hardwood versus
yep.
LVP. There's a lot of things in there. So it seems to me like we should look into that. And I was actually quite surprised by the $900 costs that you mentioned. I for some reason thought it was like $2,000-3,000
No,
generally.
if you
So
hire an engineer to come out, walk the property and all of that, yes. But like I said, I'm gonna get the company that Ashan used, and it's way the hurdle is way lower than that $3,000 requirement.
okay, awesome. Yeah, so that's great. And this is a super amazing and informational discussion for me too. I wrote a bunch of notes here. So I hope you all did too and you found it valuable. Renisha, thank you so much for being on with us today and educating us about bonus appreciation and cost segregation and how you can apply that. Again, we'll share the recording with everybody. We'll follow up with some links as we promised, and look out for some future webinars that we're planning for you as well. So thank you so much.
Thanks for having me.
All right, take care, everybody. Bye.